Hello everyone. We're here with Professor Pradeep Yadav. He's a former IAS officer turned academic who's now served on the boards of multiple companies. He's also been a professor at multiple universities in the US and the UK. He's currently a professor of finance at the University of Oklahoma, where he's the W. Ross Johnston Chair. Professor Yadav, tell us, what's the big idea you've been thinking about?
So I think it's difficult to sort of zero in on one idea, but let me talk about an area where I have been doing some active research. And in that context, one of the things which is interesting to me and relevant for the investment finance profession is the issue of how artificial intelligence would affect trading and portfolio management strategies. So that's an area where, in some sense, those of you who are, following this kind of field know all about high frequency trading, know all about the fact that computers are being used to not only decide what to trade, but automatically execute them at the appropriate time. So now artificial intelligence has come into a new generation. So when we have thought about high frequency traders, we've been thinking in terms of and automated trading. We've been thinking in terms of something which actively started around 2010-11. Now the British government commissioned a technology, a sort of foresight study with not a study, 50 odd studies to really examine the impact of computerized trading. And part of that did extensive interviews with traders from Wall Street and the City of London. And the unequivocal bottom line from there was that the programs are simple. The people who write those programs don't write them in layers. They write them as relatively straightforward, whether it is trend following, liquidity supply, or whatever. They write them as relatively simple programs. And therefore, they when they're going to get stuff, they sort of those programs are obviously completely useless at that point, and so they get out of the market at times of trouble. Now, AI has entered a new generation, and the generative AI that we've all been hearing about, and the question arises: how will trading and portfolio management of you and I and institutions change in the wake of that? Now, the first thing which you might think about, or you might ask, is, hey, we all thought that markets are efficient, and if markets are efficient, then what do we need to worry? All we need to do is just to put our money in a selection of stocks, and our returns will be equal to what is commensurate with the risk involved with those stocks. Now, yes, that is true. Markets are by and large efficient. But what is it that makes them efficient? What makes them efficient is the fact that there are traders in the market whose comparative actions, if the price is too high, they would sell. If the price is too low, they would buy. It is those actions which make the market efficient. So even within a perfectly efficient market structure, you have what is called arbitrage strategies, which essentially involve assessing, if the market's overbought, oversold, and taking actions accordingly. And that is what pulls the prices back into alignment, if you like. Arbitrage can be direct. You can have, for example, in India, you have single stock futures, and you have the actual stock trading in the market. They represent the same asset. They cannot be too far away from each other. They are connected inviolably by an arbitrage relationship. So the actions of traders would ensure that, yes, these things can move out of line all the time. Now, in this context, somebody who's an automated trader has a real head start over somebody who's a human being.
Because they can react faster.
They can collate a large amount of data. They have the cognitive ability of human beings to be limited, while these machines can collect a lot of data, analyze the data instantly, tell you straight away, and actually execute the trade. And before I could have even thought as a human being what's going to happen. And so that's straightforward. They will always have, machines will always have an upper hand. Now, trading can also, now when it comes to arbitrage with respect to, say, the futures contract, it's open and shut. When it comes to deciding whether a stock is overvalued or undervalued without any reference whatsoever, then that is not it's not the same thing. It's not straightforward. And if you ask 5 Nobel laureates in economics what the value of a particular asset would be, you'll get 5 potentially widely different answers. So there is an element, there is a very strong subjectivity to the valuation process. And in that context, one has to think about where do human beings enter, and where do machines have an advantage, where do human beings have an advantage. And in that context, I think it's important to understand that the field of finance, if you talk to 99% of portfolio managers, 99% of finance professors, 99% of the investment world, ask them what is risk, they would give you a very quantitative answer. They would say, well, risk is the standard deviation of returns, the volatility of returns. Yes, that's true. How do they get at that risk being the volatility of returns? What they say is, well, I look at the future, I think about forecasting the future, and if I say, well, the probability of this happening is X percent, the probability of this happening is Y percent, the probability of this happening is Z percent, and then you compute the expected variability of returns based on your probability estimates and based on your estimate of the return associated with each of those probabilities. So you are assumed to be some kind of know-it-all, and that is not true in actual practice. So the whole finance field is based on thinking that you can forecast probabilities and returns. Yes, you can forecast them to some extent. And so, for example, in a war situation, Um, if you have a general, he is interested um, he knows that there are things he knows. There are also things which he knows he does not know. There are also things which he does not know he does not know.
Right.
There are things that you don't know you don't know.
Right.
And that is a new field in finance called ambiguity.
Okay.
And you can in the relatively older economic kind of context, wouldn't call it Knightian uncertainty. So uh, um, if you have a box full of red balls and blue balls, and you know 50 that out of 100 balls, 50 are red, 50 are blue, you draw out a particular ball from it, you know 50% chance that it's a red or a blue.
Right.
That is what conventional risk measures do.
Because you have a prior.
You
and
have
you
a
can
prior,
test. Right.
and you can test it.
Right.
You assume you know everything, and you say, well, probability is 50%, probability of this is 10%, probability of this is 10, and compute the whole thing. Suppose I tell you the box has blue and red balls. I know it has at least 10 blue balls. It have at least 15 red balls. I really don't know how many of the others there are. That is ambiguity. Now, if I'm looking at trading by machines, how does a machine trade? It is programmed by human beings. How do human beings program it? Human beings program it based on assuming economic laws, based on assuming that if this happens, this will happen. If this happens, this will happen. If this happens, this will happen. Right? So they assume a certain set of probabilities, and that's how they would program and assume that this is going to happen. When everything is hunky dory, when the world works well, a lot of the time they'll get it right more right than more wrong, and they'll make money. Machines have the advantage of speed. They have the advantage of greater cognitive integration instantly, which human beings can't have. So they will beat you. However, when it comes to all of this, they are pre-programmed. They are programmed before the event. And you are one machine programmer, I'm another machine programmer, somebody else is a third machine programmer. We've gone to the same business schools, we've gone to the same economic principles, we've gone to the same textbooks. We program similarly. So all those programs would be similar.
So our rules of understanding the market are fairly
common. And they would be herding. They'd all be on the same basis. And this is all pre-programmed. Now, when something unusual happens, the pre-program is only as good as the information it feeds it. The human being reacts in real time. So, two of my research papers, for example, show that when the wrong things hit the fan, then the human beings are the ones who take over. Human beings do better than machines. When everything is going well, machines do better than human beings. And when things are going well, human beings can't compete. As soon as things get awry, human beings become the kings of the process.
Because you're in new territory, something that your data would not have trained the machine to react to.
Exactly. And you have to also appreciate the fact that the data cannot be trained. It's ipso facto impossible for it to be trained. Why? Suppose you're going on a plane. Now, if you're going on a plane, you know that there is most planes would work most of the time on autopilot. Why do they work on autopilot? Because of the fact that you have the laws of physics, the laws of nature. The machine which flies the plane can be programmed exactly based on, and those physical laws are inviolable. They can be programmed exactly. If this happens, this happens. There is very little uncertainty involved in the physical sciences. In the economic sciences, that is just not the case. Economic sciences are, everything is subjective, preferences are subjective, how you react would be different in different circumstances. And so, irrespective of how brilliant you are, it is conceptually impossible to really properly program everything in advance. So yes, the artificial intelligence setup is the new generation of artificial intelligence is going to will make the normal times even better than what they are today, because they would be able to take into account more things in a more intelligent way, but they definitely almost cannot substitute human beings when in times of which are complex, in times where things are happening which are not expected to happen. There's one more thing which is relevant here, and that is the following. The people who say, oh, why shouldn't you be able to predict prices? And I want to explain why prices would not be predictable under in any efficient market. So, for example, look at the price today. If I am looking at the price of Reliance today, the price of Reliance is based on all the information which exists in the market today. There'll be some public information, there'll be some private information. People would have traded on both the public and the private information. There is an equilibrium of people who are buying, who are selling, and the competitive equilibrium produces a price, which reflects all information today. If the market were perfectly efficient, as pretty much close to is. And tomorrow, what will the price reflect? It will reflect the information which will exist tomorrow.
But it will only emerge tomorrow.
But it only emerges tomorrow. The information which exists today includes all expectations of what is going to happen in the future. It's not hard information we're talking about. We're talking about soft information as well. We're talking about expectations as well. We're talking about everything, the totality of information. That is incorporated in the price today. Totality of information is incorporated in the price tomorrow. The price change from today to tomorrow would be based on something which we don't know today. And therefore, ipso facto is unpredictable. It cannot be predicted. So to say, oh, I am very good at my job, and therefore, I can put this into a machine and program it. Yes, you can program lots of things with the machine, but the prices per se would be unpredictable. Areas where trading can is perfectly consistent with an efficient market are, for example, arbitrage, are, for example, traders who who take positions because they want to hedge a particular exposure. So that's arbitrage and hedging. Hedging is, you know that you just want to reduce exposure. You're not taking on a position in order to be able to profit because from its direction. And third would be people who supply liquidity to the market over a short period of time. So if I want to sell Reliance, I need somebody who will buy Reliance and who's willing to stand there and say, I know I'm willing to buy Reliance at such a price. Those are called limit orders. And they are supplying liquidity which will fulfill my need of immediacy to sell Reliance. But that is obviously not free. There is not a free lunch. Therefore, there is a difference between the buying price and the selling price in the market. There's a bid-offer spread. Limit order to buy is not the same as limit order to sell. There's a difference. There's a category of traders who are involved in supplying liquidity, perfectly rational in an efficient market. These are the three rational things which you can do in a perfectly efficient market: arbitrage, hedging, liquidity supply. In terms of predicting the path of prices from today to tomorrow, if the market's efficient, you cannot do it. And therefore, a machine can't be programmed to do it. And when it comes to conditions which are stressful not in the sense, stressful in the sense of being unpredictably abnormal, then human beings are the ones who are who benefit.
And so we've already experienced the sort of downside of momentum trading and things like that with flash crashes and algorithms wreaking havoc during moments like these, right, where the incident was so far away from the mean that the algorithm did not react sensibly. It overreached perhaps, whereas humans perhaps waited it out and did not react so badly.
Sure.
Do you feel that this is going to get exacerbated with the new way the technology of AI is evolving, where earlier it was sort of predictive algorithms, like you said, a series of complex but still if-else statements, whereas now we're dealing with a black box where explainability becomes so hard to decipher? And do you think that's going to compound the difficulty of working with AI in the markets?
I don't really think so. I think that what the new generation of AI is going to do is to make the earlier models which were used in automated trading more like second order models rather than just first order models. Okay. So they would be better. They would be more efficient in the way they react to predictable situations. So under normal circumstances, they would do a better job. They would take more factors into account in a purely short-term, ultra short-term predictable setting. But that would be under normal conditions. As far as, so conditions can be determined by the microstructure of the market, which would be the predictable part. Or the conditions can be determined by fundamental new information and uncertainties coming in that cannot be taken, there will be no difference with respect to that. Human beings still reign supreme. So human beings have a slightly more higher bar in relation to doing better. But in any case, they would do better only in situations which are where in times of ambiguity, in times where you are in a situation of you don't know what you don't know.
Right. But looking back at the last 3 years, starting from COVID, then going into the war in Ukraine and the multiple geopolitical conflicts that have arisen, what it seems to me that what I seem to derive is that there's going to be a place for humans in trading, at least for the foreseeable future. The AI might help you, but you always need a human to ensure that your downside is at least limited to something reasonable.
And it's not just a question of downside, even your upside. So I would say it's complementary. The machines add value. AI increases that value. Humans also add value. They are also necessary and valuable in the whole ecosystem, whole investment ecosystem, trading ecosystem.
So you see these as complementary skills, not as skills that would replace or substitute one another, but more that different kinds of skills that need to come together in order for you to be successful at trading.
I completely do. They are complementary. Both are. If I am running a trading operation or portfolio operation, I do have both, and it would not be just confined to kill switches. It would be, as has been the case in the early generation of automated trading, but it would be more active human intervention.
All right. Thank you, Professor Yadav.
Thank you. It's been a pleasure to talk to you.
Thank you very much.
Cheers.